All right, so this is Fastenal versus Raytheon, and I have to say that this is almost a far-gone conclusion. I've followed Raytheon for quite some time. We do have a sell signal on Fastenal, and there is literally just no better alternatives for us to get into. Not only that, but the program is calling for Raytheon as well. But let's take a look anyway and just see what the differences are, and see if maybe hey, we stay in Fastenal. I don't know. So first things first. The program was calling for something like 300 shares of Fastenal. Raytheon is not double the price of Fastenal, but almost double. And so I imagine that we won't be able to purchase as many shares of Raytheon as what the program is calling for Fastenal. The dividend is a bit better, so that's not bad. Looks like Raytheon came from a long way. Price was 25 and now it's 83. So that's huge. Um, of course, that means that the PE ratio is going to be much larger. Um, Also, too, Raytheon is primarily government contracts and things of that nature. So a lot of government spending is going to play into this, and I'm pretty sure that the big infrastructure deal that went through has a lot to do with the price performance of Raytheon more recently as well. Um, so yeah, so the price to earnings ratio is just sky high. As you can see, the 5-year high is only 16, and it's currently at 50. So that's crazy. So we definitely want to be cautious. We don't want to purchase at the top. So I may look at possibly selling some options versus just buying in directly. Um, let's see. So again, these companies are a bit different, so I'm not going to really be able to compare them. I really would have to have like their direct peers here to really give a good comparison. But net profit is a bit better for Fastenal. Return on assets better. Raytheon has way more cash on hand. Honestly, I don't know if that has more to do because both companies do manufacture. I think Raytheon probably has bigger contracts. Fastenal has more contracts, but for less money. So I don't know. Maybe there's just some clunkiness in how the cash comes in and out of Raytheon versus Fastenal. But we definitely do like to see more cash because that's just safer basically. All right. The cash to debt ratio is better for Raytheon. I don't have as much debt on the books. The short interest is better. It's not as many people betting against Raytheon, so that's not bad. The looks like the price is just off of its highs for Fastenal, and looks like it still has a little ways to go for Raytheon. So that's good to see. Um, and it's Raytheon, of course, is way above its 52-week low. Now, this is the thing that I was really interested in seeing, right? So we talked a little bit about this in the market update that there seems to be a bit of a change in trend towards more growth, towards more return. And so we see Fastenal is better in that category, better in up moves. But of course, Raytheon is a better defensive stock. So, again, it's I think the long-term trend is definitely defensive. The current trend is still defensive, but again, starting to turn a bit more bullish. See, volatility is a little better for Raytheon, and of course, the price is uh, lower. Let me look at this. What is something? Oh, that's right. Okay. Um, this always confuses me because what happens is that the down score is is not a positive, it's a negative, and so the the smaller number, which is weird to say, but the smaller number is actually the higher score. Um, so anyway, so yeah, I mean, I think it's again, I think it's a foregone conclusion. Fastenal is definitely the better stock as far as returns go, but Raytheon is definitely a better defensive play. But with that being said, more recently, I mean, it looks like the price has just skyrocketed out of this world. And with that PE ratio so high, it does give me a bit of pause. So again, like I said, I'll look at some options before just purchasing the stock outright.